Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. And we've been talking about, got into a little bit of politics there. And the reason for this, again, is to prepare you. Back in 2016, when it was leading up to the election, I was sharing some things at that time. And it was interesting because when you look at it statistically, whenever power changes over from one party to another, so the thinking being that if the Republicans were to win when the Democrats had been in office for 8 years, that the market typically goes down. And it goes down for a period of about 3, 4, 5 months, kind of thing, and then it would kind of balance back out based on other factors. So this was one of those, we were like going into the election, there was a lot of talk that said that if Trump were to win, that the market would tank, and at least initially, and then, you know, after about 4 to 6 months, it would start to level out based on more of the facts of the market rather than the fundamentals rather than just that piece. However, this time around, we've got something similar. Okay, so you've got that concern. And by the way, what happened last time, the market looked like overnight, over the election night, that it was going to be a very ugly opening. But in reality, it didn't. It righted itself, and the next thing you know, the market took off and had a nice run there. So we don't know on that alone what's going to happen, but policies we can look at. And it's not about personalities. It's not about, you know, whether you like someone or don't like someone. It's about thinking in terms, being very practical as far as what could happen and how to protect yourself against these things. In particular, if we were to go into another bear market, all right, into another recession, what would that look like? So we had, like this time, it looks like this could be like a recession over in like 2 quarters. That's a really short one. Okay, compare that to 2000 through 2002 and the time it took to recover from that, you know, 5 years to recover from that market. And then if you think of 08, okay, the financial crisis, you had basically about an 18-month period there where the market tanked about 55% over that 18-month period from October of 07 to March of 09. So these are things to consider anytime in planning, because there's going to be bear markets. That's just part of our business cycle. There are going to be recessions. The question is, could this election, if the Democrats win based on the policies they want to implement, could that in fact push us into that? And there's a lot of people that believe that it very much could. I'm one of them. I think based on the policies they're talking about, raising corporate taxes, increasing regulations on businesses to make it more difficult. In particular, their goal was to put the coal business out of business, and they almost did. They almost put that industry out of business, and now it's been resuscitated somewhat. But that's just one of many. These are things that you need to begin considering, because when it comes to your retirement, okay, it's not like we can just go back to work necessarily, right, for the next 20, 30 years, okay, or whatever it might take to get through. 20 to 30, I say, because that's how long your retirement's going to be. One of the things that comes to planning then is we have to, again, plan for the worst. We hope for the best, plan for the worst, and worst case scenario, we may end up with more money than we expected. That's not so bad. So when it comes to planning for your retirement, think first about these risks, these real risks that are out there, okay, and what we may do to help protect ourselves in a down market. So what might that look like? If you've got all your money in the stock market, and you're maybe in your 401ks and IRAs, thrift savings plan, TSP, and you're invested in the market, and you're thinking, well, does that mean I need to put everything in a stable value fund or my G fund, or, you know, go into the least risky of things? And not necessarily. That's not. In fact, that's not what I'm saying, because it's not about timing the market by getting out of the market. It's about having a proper asset allocation model, first off, that can withstand a little volatility and recover faster. And I've talked to you many times about that. Myths and truths of investing just a few weeks ago, delving into how asset allocation can help protect you in down markets. But the other was to also have a certain amount of money set aside for income. So to think in terms of preparing for retirement, think when it comes to these kind of events that we're looking at, think like, well, for the next 3 to 5 years, let's say we're going to a recession or a bear market, how long does it take to ride that out? Is it 5 to 7 years? That's the last 2 bear markets, with not counting the one this year, of course. The last 2 bear markets, and how long it took the markets to recover, 5 to 7 years. So would I need to have that much money set aside? Or, okay, proper allocation. The portfolios that I talk about all the time that I use with my clients in my office, those portfolios recover in about 2 to 3 years. So technically I look at it from the standpoint 3 to 5 years being a safe bet when it comes to setting aside for income. So I think in terms of income for the next 3 to 5 years, where do I get that? So I've got Social Security, maybe I've got a pension or rental income or whatever my assets may be, or or income sources may be, and in my assets as to how they may help plug the difference. So my retirement accounts, I look at taking income from those. Now, whether I'm at an age where I'm doing required minimum distributions, or I'm just setting up a systematic withdrawal to supplement my income to be able to maintain my standard living and quality of life, right? Simple stuff. So in doing that, all right, and preparing myself for that, I think then, okay, over the next 3 to 5 years, if I go through a bear market recession, or at some point that may happen, where's my income coming from in the next 3 to 5 years? For the next 3 to 5 years. Do I want to position some money, maybe if I'm in a portfolio that's 60% stocks or 75 or 80 or whatever it might be, and I may want to say, well, if it's going to be more volatility, the more equities, the more stocks I have in the portfolio. So therefore, how do I protect myself if those stocks drop in value? I don't want to have to sell my stocks cheaply. Okay, and by stocks that includes, of course, stock mutual funds, all right, or exchange traded funds. Any of these, if the market drops, I don't want to have to sell those at a cheap price, okay, and to take income from them. What's the downside? When the market goes down, and I have, say, 1,000 shares of something, and that 1,000 shares, let's say, is at $100 a share. So now I've got $100,000 in this one investment. If the market dropped in half like we had in the last 2 bear markets, all right, now I've got $50,000. My shares are only $50 a share instead of $100 a share. If I start selling those to get income that I need to live on, I've reduced down, instead of 1,000 shares, right? I'm going to be selling some of those off. Maybe I've got now 900 shares or 800 shares or whatever it might be. So when the market goes back up to $100 a share, what's the problem? Well, if I've got 90 shares or 900 shares now, I've only got 90,000 instead of 100,000. I didn't do so well, did I? Okay, that's why when we talk a sequence of returns risk, when you're retired and you're pulling money from a portfolio to supplement your income and you go through a bear market, it puts you at more risk to run out of money. So we need to be thinking of moving some of that money into something that wouldn't be as volatile, okay, or something maybe even on a guaranteed income basis where I know I can count on this income for the next 3 to 5 years, where I can ride out that bear market, right? I can go, let my portfolio, don't have to take money out of it, let it go down, let it go back up, and be fine. Okay, that's the kind of planning that becomes very important when you start thinking in terms of these risks that right now, the election risk that's there. In particular, this is the time to be looking at your portfolios, making sure your asset allocation model is correct, and at the same time be thinking, do I have that pool of money I may need for the next 3 to 5 years of income that I would need to be pulling from that normally. All right, we're going to get into some other things here this morning. Picturing your retirement being one. Think in terms of what you're going to be doing in retirement, looking at key milestones, we'll talk about that, and then preparing for living in retirement. So how do you picture spending your time? What kind of leisure activities do you enjoy? Planning for that. Remember, we talked about needing a certain amount of money. I just talked about, for instance, the income piece, right? Well, some of that is for just the normal things, paying my bills, my utilities, my taxes, my medical, food, all those kind of things. But then we also have leisure activities that we want to account for as well. So let's look at, there you go, what about going on a cruise, travel, or, you know, now even though right now a lot of people aren't thinking it as much on that, or it's certainly tamed down, it's actually starting to pick back up again from a lot of what I'm reading. So this is a big plus, and we will get through the virus piece of that. We will see these, you know, getting back to some form of normalcy, if you will, as vaccines and other treatments are showing more and more promise. So with that, we need to be thinking more long-term, not short-term. Not about the next 6 months, for instance, because I think by the end of this year, we'll probably have at least one vaccine, and of course the treatment protocols have improved dramatically as well. So they're going to reduce down the mortality rates even at the higher risks of our population, and even more so on the lower pieces. So we need to be thinking long-term when it comes to retirement. For instance, the life expectancy has increased 30 years in the last century. Think about that, okay? The amount, so is it we're living longer in retirement. In fact, age 85, the 85 plus population is the fastest growing segment of the population. People are living longer. So if you retire at 65-ish, in that range, you got to be thinking of at least 20 years in retirement, possibly longer. For a married couple, I think age 65, the statistic was something like 25% chance that at least one of you, well, here it is, 1 in 3 chance, so it's a little higher than I thought. So a 1 in 3 chance that one member of a couple will live to at least age 95. Now you're talking 30 years in retirement. Do you have a plan for that? Okay, in other words, are you planning to make sure that you don't run out of money over a 20 to 30 year period of replacing a paycheck that's no longer there? I think it was Mickey Mantle that said, I would have taken much better care of myself had I known I was going to live this long. Okay? Let's think of our finances that way. Let's take much of, you know, you could be living a very long time. Let's make sure that we're taking care of our finances so that we're able to attain and maintain our standard of living and quality of life no matter how long we live, and never have to worry about running out of money. You know, for life expectancy at age 65 for women is 86.6 years, and for men 84.4 years. And as it said here, and this is a nationwide study, by the way, it's an excellent study. Retirement planning guidance suggests individuals establish a retirement income planning horizon that ends no younger than age 90. In other words, when we're doing planning in my office, we run it out actually to age 100. Okay? People are never going to be upset of having too much money, always about having too little. None of us want to worry about running out of money, picturing ourselves at a time in our 80s and be broke. Okay, that would be bad. We don't want to do that. So in a recent survey, most responders, in fact, 5 to 1, said they plan on living a more active lifestyle in retirement than they had during their working years. So you know, that's good both as far as health goes and quality of life, but also means that I think it feeds into this piece about people living longer. And if you're living an active lifestyle, that means you may need more money in retirement than just what you're even making now. That fun money piece being in there. When every day is a weekend, that's when we spend most of our money, and when we most have, you know, time for our leisure activities. Now imagine you're retired and every day's a weekend. You think your expenses are going to go down when you've got more time and hopefully the health and able to get out and pursue those leisure activities? Not so much. There's some other factors too. If we'll take a break, I'll get into those when we come back. Join me here. We'll be right back on the Retirement Report.